In this example, we are going to take a look at interest expense on a note payable. On the last day of October, Wright Company borrowed $120,000 on a bank note for 60 days at 11% interest. This means that Wright Company went into the bank, got a loan for $120,000, and agreed to pay it back in 60 days and also agreed to pay 11% interest on top of the amount borrowed. We are to prepare the following journal entries. So for the first journal entry, we're going to record the actual borrowing of the money. So on October 31st, when we borrow the money, we in turn receive cash from the bank. So we're going to increase our cash account in the amount of $120,000. Now once we sign the note and agree to pay them back, we have created a liability for the company in the form of a note. So we increase our notes payable account for the principal amount, which is the amount that we borrowed. Then on November 30th, we have to record the accrual of interest expense. The reason we have this journal transaction is because the end of our accounting period is November 30th. And according to the matching rule, we have to do adjusting entries and make sure that our expenses are recorded in the accounting period in which they occurred. So this note spans two different accounting periods. So November 30th, we're going to record the interest expense for the amount that should be expensed between the last day of October and November 30th. And we're going to create a liability at that point because we're not paying the note back. So if we take our principal amount of $120,000 times our 11% interest rate and then times 30 days divided by 365 days, we get $1,084.93. So the $120,000 is the principal, the 11% and the rate, and the 30 days is the amount of time that has passed between October 31st and November 30th. So we are recording 30 days worth of interest for the accounting period which it is incurred. And the reason we are putting a credit into interest payable account is because we owe this interest, it's just not yet ready to be paid. Then on December 30th, we are going to record the payment of the note. So to record the payment of the note means we no longer owe $120,000, so we will decrease or debit our notes payable account in the amount borrowed, $120,000. Then we're also going to pay out cash, as you can see. So the interest payable for the 30 days that had expired but not yet been paid, so we will take that $1,084.93, and then we also have to pay the remaining interest for December. So the interest payable represents the amount we recorded as the accrual, and the interest expense account in this transaction represents the amount of interest that is actually expensed in December. So the total amount that to be paid back is the amount that we borrowed plus the interest for both accounting periods.